Hi, welcome back to Elements in Focus. Today we're going to be going through our third critical element, and that's the investment playbook. We're going to be discussing diversification best practices. My name is Rheaume. I'm the Director of Financial Planning at the Financial Enhancement Group, and I've got one of our advisors, our lead advisor in our Lafayette office, Jamie Burton, here with me today. Jamie, how are you?
I'm good. It's summertime, so definitely can't complain.
Yeah, and it's actually starting to heat up here in Indiana. We've
Yes.
been blessed with a ton of rain and now it's hot and humid. So, um, if you're new to watching our Elements in Focus video, this is where we cover one of our 5 critical elements every week with one of our advisors on our team. As I mentioned, today we're going to be discussing the investment playbook. Jamie, can you just break down like what is diversification and why is it important inside of a portfolio?
Yeah, absolutely. So when we're looking at diversification and investing, it's the strategy of spreading your investments across different assets to reduce risk. So I'm sure you've heard the metaphor, don't put all of your eggs in one basket. That's really important when we're looking at investing. We don't want to have, like it says, all your eggs in one basket. You drop one basket and everything is just gone and destroyed. You want to be able to have it spread out across different asset classes and different sectors and different ways that you can invest your assets, where if one thing goes wrong, you still have other things that are holding up your portfolio and keeping you in a good spot. Why diversification matters: you really want to protect your portfolio from losses in any one investment. So you have different assets that respond differently to different market conditions, which is why you don't just want to be all in one stock or one bond or only stocks or only bonds. You want to really be able to have that spread across different things. Ways to diversify, like I said, different asset classes. So you want to have different stocks, different bonds, real estate, cash, private equities, different alternative investments. There's a lot of different ways that you can get that diversification where you're not just specifically in the stock market. We also want to look at diversification within different asset classes. So, say you're looking at stocks, you can have diversification in large cap, small cap, international, different sectors that we look at, like financial, tech, healthcare, that sort of thing. With bonds, you have government bonds, corporate bonds, municipal bonds, and then you have different durations for those bonds too. And then you can look at the investments by their style. Is it a growth investment or a value investment? Is it a passive index fund or is it active management that you're going for? And then you really don't want to limit yourself to US markets. You also want to consider some global exposure in there as well. Common mistakes that we see when people are managing their own investments is they think that you're looking at mutual funds, they think that if they own multiple different mutual funds that they're diversified. The big problem that we see with that is that mutual funds, they overlap with what they're holding inside of those funds, and a lot of the times their top 10 holdings are very, very similar. So if something happens to one of those funds that are in the top 10, it's going to affect every single mutual fund they have, and they're not as diversified as what they thought they were. So that's definitely a big one that we see, mistakes that people make. And then over concentrating in one company stock or one sector. Apple's a big one that people talk about. It's done well for such a long time, but it can also take big hits. And if all of your money is in that one stock, the Apple stock, it can really affect your portfolio short term and long term. So over concentrating in one is not a good plan. And then people sometimes do the set it and forget it, and they don't actually go in and rebalance based on different changes that are made. So that can really affect how their portfolio does long term as well. So making sure that you're actually looking at your portfolio and making any changes that are needed in that portfolio. So some best practices that we like to look at: use some low cost exchange traded funds to get some diversification if you don't have a large amount where you could diversify again with individual stocks across different companies. Like I said, rebalancing your portfolio periodically. That's not all the time. That's not something that you want to do weekly or maybe even monthly. It could be something where it's semi-annually or annually, but just keeping an eye on that and making sure that you're making moves that make sense. And then you really want to diversify based on your goals, your timeline, and your risk tolerance. So while we talk to our families about diversification, it's not going to guarantee you profits, but it can help manage risk and give you a smoother investment journey over time.
Very well said. And again, in a lot of these, there's a ton of stuff to unpack in a short amount of time. And so Jamie essentially covered investing basics 101 in 5 minutes. There's multiple things that we do from a diversification standpoint. Big points and takeaways is making sure that you don't have overexposure in one concentrated stock. Here at FEG, we like to keep our stock positions somewhere between 2 and 5% of our overall portfolio. Another key point that Jamie made is looking at different sectors. Sometimes different sectors of the economy perform better at different times under different administrations, under different laws and legislations. And so for an example, let's say we think the financial sector is going to do well this year, and this is not a plug to go invest in the financial sector, but if it's something that we identified, we might go in and buy the entire financial sector through an exchange traded fund rather than trying to pick Chase Bank or Bank of America or another financial company. You can go and buy the entire sector to spread that diversification out as well. Good adding in international markets this year in 2025. They've done well. The last 10 years, they've been a real laggard, but you still need some exposure outside of the domestic United States. Another area that FEG adds is outside of the common stock, bond, cash, is looking at alternative investments. If that's not something that's part of your portfolio, it's something that you really need to consider, and we can get into a deeper dive on that. If you have questions, if you want to know more, and if you want just a review of your portfolio to make sure that you're aligned with your risk tolerance, please reach out to us. Schedule a complimentary next steps meeting. That's where one of the advisors on our team will sit down with you for an hour to an hour and a half, review your situation, your unique situation, give you things to think about today, things to think about in the future, and if we decide to partner together, what FEG will do for you in a written plan. You can contact us at 800-928-4001. Go to yourlifeafterwork.com or scan that QR code that you can see on the screen. But most importantly, thank you so much for watching. We hope you have a blessed day, and we will see you in a week.